arbitrage, pricing theory, and multi-factor models of risk and return. I'm Mike.
Austin.
I'm Jerry.
So for the single factor model, returns has returns on the security come from two sources. One being firm-specific events, the other common macroeconomic factors such as like GDP growth, interest rates, and other factors we'll list on. Here's a single factor model. RI is the excess return on security, and then we have BI, which is the factor sensitivity or the beta, the factor beta, and F is a surprising macroeconomic factor, and F could be either positive or negative, but has an expected value of 0. EI, and then EI is the firm-specific events. For the multi-factor models, we use more than one factor, and examples of factors can include market return, GDP, expected inflation, interest rates, and estimate the beta or factor loading for each factor using multiple regression.
Could you speak up a little bit?
Yeah. And then
This
here's
is the really important equation right here.
Yeah, this is the multi-factor model equation. You have RI again, is excess return for security I, and then we have B, lowercase I, GDP, which is a factor sensitivity for GDP, and then we have BI, lowercase I, and then IR, which is the factor sensitivity for interest rate, and EI, which is the firm-specific events. Interpretation. The expected return on a security is the sum of the risk-free rate and the sensitivity to GDP times the GDP risk premium plus the sensitivity to interest rate times the interest rate risk premium. And then for arbitrage, pricing theory, arbitrage occurs if there's a zero investment portfolio with a sure profit. There's no investment, and investors create large positions to obtain large profits. And all investors will want an infinite position in the risk-free arbitrage portfolio. And then in effective or efficient markets, profitable arbitrage opportunities will quickly disappear.
Okay, so the law of one price. The law of one price states that if two assets are equivalent in all economically relevant respects, then they should have the same market price, and which is enforced by arbitrageurs. If they observe a violation, then they will engage in arbitrage activity. They'll bid up or down the price where it is low or high until the arbitrage opportunity is eliminated. And arbitrage is essentially the difference in market and intrinsic values. This is for a well-diversified portfolio, where F is a systematic risk. For a well-diversified portfolio, the firm-specific events of the portfolio moves to 0 as the number of securities increases, and their associated weights decrease because there's more securities. Yeah. So this is a chart showing the difference between a well-diversified portfolio and single stocks. You can see the well-diversified portfolio on the left is more in line, rather than a single stock, which is more all over the place, more volatile. Here again, we can see the solid blue line is the well-diversified portfolio, which comes in at a 10% return rather than an 8% return for just a single stock on its own. And here's an arbitrage opportunity. You can see at point C, it's below the expected return, so you could arbitrage that. And then this is a no arbitrage equation of APT, that ERP equals applies to well-diversified portfolios and establishes that the security market line of the capital asset pricing model applies to well-diversified portfolios.
Alright. So APT and CAPM. So APT assumes a well-diversified portfolio, but residual risk is still a factor. Doesn't assume investors are mean variance optimizers, and uses an observable market risk and reveals arbitrage opportunities. While CAPM is a model is based on inherently unobservable market portfolio and rests on mean variance efficiency. The action limiting small investors restore CAPM to equilibrium. So multi-factor APT. So use of more than one single systemic factor requires formation of factor portfolios. And what factors? Factors are important to performance of the general economy. And what about firm characteristics? So we're going to go into the different kinds of APTs. So the multi-factor APT is similar to the one-factor case. It's so all of the variables are essentially the same, but you take into but you track with diversified factor portfolios. So B equals or beta is 1 for one of the factors and 0 for every other factor. And the factor portfolios track a particular source of macroeconomic risk, but they're uncorrelated with other sources of risk. So the FAMA French 3-factor model includes SMB, which is small minus big, that's the firm size, and HML, which is high minus low, which is book to market ratio. So the FAMA French really takes into account size risk and value risk, as opposed, The multi-factor CAPM and the APT, the multi-index CAPM inherits its risk factors from sources that a broad group of investors deem important enough to hedge. The APT is largely silent on where to look for price sources of risk.
And who was going to go next?
We were about Tyler and
And who's going next? Where are you guys going to go?
We're chapter 12. I think chapter 1.
Yeah, were you guys ready?
Yeah, we're ready.
Okay, cool. So what I gave out to you today was the, while you guys get started, the handout that I gave you. This is basically the study guide for the Chartered Market Technician, CMT, CFA, if you heard the CFA, the Chartered Financial Planner, CFP, if you ever heard of that, CFP, CMT, Chartered Market Technician. Certification for the technical analysts. Okay, this is basically the study guide. So you may want to read through this. What I'm going to do is I'm going to also provide to you some of the chapters out of the John Murphy book. So if anybody's interested in using technical securities analysis, which I highly recommend because that's what all of us traders do. This is one of the Bibles. There's about 3 of them. This is a really good book. I'm going to probably copy the chapter on moving average crossovers to give you some literature behind the methodology. And then I'm going to give you another chapter, and I'm going to copy some chapters out of these books to provide you with some content for you to be able to add as rationale into your trading schemes, okay, for the equity set. Then the other Bible for the fundamental securities analysis is this one right here, This is the Bible by Benjamin Graham and David Dodd. They basically wrote this thing in the 40s and the 50s. Actually, in 1934, they wrote the first book on securities analysis. So this is the Bible book. You guys are interested in collecting some of the classics. And then obviously, Henry Markowitz, this is his book that he wrote on portfolio selection and invented modern portfolio theory. This is the Bible too. I like to have these things around me. I'll try to share some of the content out of these books with you. Sorry, didn't mean to cut into some of your time.
Alright, so thank you for tuning in to Chapter 12, Behavior Finance and Technical Analysis. This chapter will go through, obviously, behavioral finance and some of the intricate parts of technical analysis. In order to understand behavioral finance, you need to have a solid understanding of efficient market theory and hypothesis. States that based on the information that happens outside in the economy, that investors will act upon that information and stock prices will reflect that information without any arbitrage opportunity. However, behavioral finance critiques that conventional finance kind of theory by saying that based on information, investors are subject to their psyche and behave irrationally. Now, limits to arbitrage and levels in behavioral economics kind of the critique of that, saying that even though information can be processed and reflected inside the stock market, not all arbitrage opportunities are big enough to force prices to reflect the information within the economy. Here are some differences. Again, in conventional finances, prices are correct all the time and reflect the information. However, in behavioral finance, the main kind of kickback is what if investors don't behave irrationally and are subject to the biases that they have growing up and biases they have such as fear, for example. Now, there are multiple types of irrationalities. Is that the first one is what I see as the most common, is that investors don't really process information correctly. They'll see a 2, but they think it's a 4, stuff like that. This can mean during their analysis, probability distributions are incorrect. This is extremely seen is that an investor doesn't normalize their distribution. Another thing is a suboptimal decision, as described here, is if a framed state or described investing opportunity is seen as greater than the other, while the description of that opportunity is considered suboptimal and not all information has been gathered and processed. So when information processing occurs when an investor is making a decision, these are the 4 types of errors that can happen. The first one is forecasting. Forecasting errors involve experiential experiences that happen within a short amount of time frame in the next investing decision. So let's say something happened in the market for the past month, and I'm about to take another investing decision. Based on what I've experienced in the past month, I may use that bias to move into another investing decision. The second one is overconfidence. Is exactly what it is as an investor sees something they feel extremely strong about, they let their emotions take over and invest or not invest or take a riskier bet. Conservatism kind of gets at the different levels of asset classes which an investor has to deal with. And so they may take an extremely large bet in something and take a very minimal bet in something else just because maybe they don't understand it or they feel as if the risk premium isn't high enough. The next thing is sample size neglect and representativeness. This is really simple. It's just that they haven't looked at enough data. It's just that the reasons why as to an investment may become successful isn't a large enough sample size, so they're using maybe 10 data points versus 5 years of data points. These are some other behavioral biases. Framing is the description under which an investment decision is offered or proposed. A good good example of this is if I were to give you an investment decision, only stating the risks of the decision, you may not take it. Versus if I were to give you that same investment decision while stating all the potential benefits, you might take the investment because I made it sound good. Mental accounting is something I've mentioned before. Is if you as an investor, say you have a child and you're investing for their college education, you may take more risk-averse investment positions so that the portfolio grows in the long term. However, if you are creating a casino fund for you and your boys to have fun, you may take more riskier assets. This is something called mental accounting. It's a good example of for different purposes in your life, you may take different risk mentalities. Finally, the last one is regret avoidance. This is something, to put it into terms that we can understand, this is something, fear of missing out or FOMO. It just means that we take action quickly on things that go bad for us. So if an investment goes bad within the last week, we quickly want to go positive. So this is actually gambling. You don't want to fall into this trap. If an investment decision goes bad, take a step back, think about what has actually happened, and go and reanalyze with a level head so that you don't fall into this trap. And these are just descriptions of all of them. Finally, prospect theory. Prospect theory gets at the different utility functions outside of conventional finance. So in a conventional finance kind of theory, the utility function on the left shows that with more wealth, you get more utility. However, with different frames of psyche, your current state of wealth outside of the different investment positions you have can frame a more like kind of S-curve based on utility function. So if you're level-headed and you make investment decisions based on pure data, you can be in the top right corner. Versus if your wealth has seen a monthly or quarterly loss, and you're changing your investment decisions based on the specific change in wealth that you're seeing during that time, you'll be in the bottom left corner.
These are some of the limits to arbitrage. Behavioral biases would not matter if the rational arbitrageurs could fully exploit the mistakes of behavioral investors. Fundamental risks, basically everything that happens to a stock by a large group of investors as well. So right there it says the markets can remain irrational longer than you can remain solvent. Intrinsic value, market value may take too long to converge. So the second part of this is implementation costs, the transaction costs, and restrictions on short selling that can limit the arbitrage activity. Also the model risk, what if you have a bad model and the market value is actually correct? So right here it gives you a graph of the Siamese twin companies, the graph as it goes. The Royal Dutch should sell for 1.5 times of the Shell price, and then it also deviated from the parity ratio for extended periods. And then this is an example of a fundamental risk. So equity carve-outs like 3Com and Palm, arbitrage is limited to the availability of shares for shorting. Then closed-end funds that may sell at a premium or a discount to the NAV, and it can also be explained by the rational return of expectations. So some of the bubbles that they identify here is the dot-com bubble and the housing bubble, which most of us know what happened there. Just overvaluing certain companies that didn't have any revenue to give back to their investors. The housing bubble was just another similar situation where they were overvaluing certain houses and people that could pay for them, so the whole bubble just burst and this sent us to recession. So the rational explanation for the stock market bubble, we can see it using the dividend discount model, you can see there. And then also the S&P 500 was worth 12,883 million if the dividend growth was at the rate of 8%. The S&P 500 is worth 8,589 million if the dividend growth rate was at 7.4. So technical analysis also attempts to exploit the recurring and predictable patterns in the stock prices. The prices adjust gradually to new equilibrium. market values and intrinsic values converge slowly. Disposition, in fact, is basically the tendency of the investors to hold on to losing the investments, and also the demand for shares depends on the price history. And it can also lead to momentum in stock prices. So momentum and moving averages. A moving average is the average level of prices over a given time interval. Interval updates as time passes. So bullish signal is basically the market price that breaks through the moving average line from below. It is basically the time to buy. The bearish signal is basically when the price falls below the moving average and it's time to sell. So right here gives you a graph of the moving average and the share price for Intel Corporation. And then the relative strengths is basically measures if a security has out or underperformed either in the market or its particular industry. And the pricing right there gives it to you. Relative strength equals the security price over the industry price index. And then price ratio implies outperformance.
So the breadth of the relative strength is often measured as the spread between the number of stocks that advance and decline in price, and then the little diagram is just a trading diagram which shows the volume advances and decliners. So trend statistic is shown right here is the formula, which is trend equals volume declining divided by number declining over volume advancing over number advancing, and then the ratio is about 1.0 pairs. For the confidence index, it's the ratio of the yield on the top 10 rated corporate bonds divided by the average yield from the 10 intermediate grade corporate bonds, and the higher values are bullish. For the put call ratios, the calls are the right to buy. It's a way of like betting on the rising prices, and the puts are a right to sell. It's a way of betting on the falling prices. And then a rising ratio may signal that investors' pessimism and a coming market decline. Contrarian investors see a rising ratio as a buying opportunity. And then warning notice, it is possible to perceive patterns that really don't exist. And the next figures of figure 12.6 is going to be based on the real data. And it shows in panel B, that panel B was generated using returns created by a random number generator. And then figure 12.7 is going to show obvious randomness in the weekly prices changes between the two panels in figure 12.6. Here's the first one, which shows the levels for the stock market prices of 52 weeks. So the changes in the stock prices.
Great, nice job. Is anybody else gonna go? No? Okay. So pull out the blue book, and on the front of the blue book, write in-class midterm exam. Modern and postmodern real estate portfolio theory. Huh? Do you have them? Okay. Anybody else need one? No? Yes? No? Yes. Okay. So the dissertation is online, along with the PowerPoint presentation.
Can you say the title again?
Yeah, modern and postmodern, it actually should be applications in modern and postmodern real estate portfolio theory. And the acronyms should be MREPT and PMREPT. MREPT and PMREPT, okay? Modern and postmodern, real estate portfolio theory. Basically, I took Markowitz's work and applied it to real estate. And the thesis was to, how do you build a multi-billion-dollar portfolio of high-grade commercial real estate? It could be, the design was to advise the company I was working with. They were about $1 billion in assets under management when they hired me. And within 10 years, they wanted to go from 2 billion, they wanted to grow from 1 billion to 2 billion. And then within a 7-year period, they wanted to go to 5 billion. And then within a 15-year period, they wanted to go to 10 billion, okay, in assets under management. Now, to be able to grow to that scale, you need to have a research-driven strategy, okay? So I think the first question was, what was the motivation of the research? The motivation of the research was to design a portfolio strategy to basically guide the company to be able to scale up to a certain level in assets under management, okay? And the only way that you could scale from $1 billion to 2 billion to 5 billion to $18 billion under management is you have to be able to attract institutional investors, okay? Not retail investors, but institutional investors, pension funds, endowments, mutual funds, investment banking clients, high net worth individuals, maybe private equity funds. They got to be able to, invest in your securities in your company. And you can't just go out there and tell these potential clients that we're going to build a multi-billion-dollar portfolio based on assets that we find within the marketplace on an opportunistic basis. That ain't going to work. Okay, the institutional investors want to see a research-driven strategy that is completely thought out and is basically a roadmap for the management company to be able to then look out over the next 5 to 10 years and have basically a plan that's completely laid out. So the dissertation basically is a manual, okay? It's basically a 360-page book that basically lays out the steps in which you need to go through to be able to build a multi-billion-dollar portfolio from a strategic research standpoint. And from an operational standpoint, we built a strategic research vertical within the organizational structure of the firm. So they had never had a research vertical within the firm before that operated at the strategic level, basically advising and working with the president and CEO of the company along with the chairman of the board. Okay, I've never had experience doing that before. And the senior level executives within the firm too had never experienced building and having a independent risk management function within the firm. Okay, they had never done that before. They were totally opportunistic and operational oriented. They weren't strategic and functional in any way. So there was a lot of problems that we went through at first. So the first part of the dissertation lays out basically the policy risks associated with building one of these portfolios. I was in the building a multi-billion-dollar portfolio of apartment properties. Okay, so the first part of the dissertation basically lays out what risks you're subjected to when you build one of these large apartment portfolios and also managing your debt and equity in your capital structure at the same time. And my thesis was that, that the systematic risks, starting in 1995, because we had the peso crisis, then we had the Thai baht, then we had the Russians default in '98, then we had Y2K in 2000, we had the dot-com bomb bust in 2001 along with 9/11, and then we had basically a housing bubble that bursted. It bubbled in 2006 and 7 and then blew up in 8 and 9 in a financial crisis. So if you just go back, to 1995, we as investment managers are being subjected to more volatility and more risk. And a lot of the volatility and a lot of the risk, from my thesis, says, and gets right into APT, is that I feel that there's a significant amount of the risk is political and policy oriented. political and policy oriented. And nobody has really done any research in adding in political and policy factors within the APT to try to forecast where expected returns are going to go, not only on stocks and bonds, but also on real estate assets. So that was basically the primer. Then, since we were doing apartments, okay, building apartment portfolios, apartments are basically part of the overall housing stock, okay, single family and multifamily. Well, single family housing and multifamily housing are subjected to policy, okay? Policy enacted by Democrats and Republicans, and actually I just finished updating this paper with a high school student that went on to Georgetown and a high school student, updated the first chapter of the book. We've been working on it all summer, and we're going to publish it next week and put it into one of the housing journals, okay? So I did a whole analysis on housing policy and housing economics, because apartments are part of the overall housing sector, okay? And then the chapter 3 was on modern real estate portfolio management. You've heard this all before, where you're basically putting together assets, real estate assets, diversified across geography, and also diversified across geography based on industry sector exposure. So the company wanted to have high industry exposure to tech-centric geographies. So we built a large concentration of institutional grade apartment buildings in Silicon Valley. We never got anything in really San Francisco, but we had properties along the 580, the 680, in Silicon Valley, and in Palo Alto next to Stanford University. So we were very highly concentrated in tech, because tech was more volatile, but it provided us with higher risk-adjusted rates of return on the portfolio over the long run, and the markets were supply constrained over the long run also. So they were willing to take that risk and move further out the efficient frontier and take on more exposure to riskier asset classes due to by industry sector. So that was basically chapter 3. And then the next chapter, and I'll go through the presentation a little bit more, I'm just doing an introduction. So that was the modern real estate portfolio management piece. And then the chapter 4 basically stated that once you built the multi-billion-dollar real estate portfolio, how could you hedge it? How could you hedge off downside risk and apply risk management strategies, apply property derivative tools to basically apply the portfolio insurance to hedge off the downside risk and lock in the risk-adjusted rate or lock in the expected return on the portfolio, lower the portfolio standard deviation by using financial engineering through the derivatives, and increase the risk-adjusted rate of return for the clients that were investing in our stock. So the first thing you need before you can apply any of these derivatives is you need an index. So chapter 4 gets into how do you actually develop an index, and then how do you design a tradable index, and then how do you design a tradable index and get the market to actually respond, i.e. the investment banks and the commodity exchanges, to basically write and develop standardized futures and option contracts on these indexes, and then to be able to write the forwards and the futures contracts, buy the puts on the futures and write the calls on the futures, to be able to hedge off the risk using those tools and those derivatives. So it's you can't put the cart before the horse. The horse is the indexes, the cart are the property derivatives. You can't do it the other way around. So that was chapter 4. Then chapter 5 basically gets into, well, do these indexes actually work? Do they actually track the valuations of the cash flows of the sectors that they're supposed to be tracking? So chapter 5 is the back test. That basically lays out the correlations between the indices and the actual underlying property values to be able to confirm that they actually do track overall real estate prices, particularly in the apartment sector. And then I basically took those prices, those indexes, those real estate indexes that were developed, and did APT on a time series basis, and started looking at economic factors that were correlated to the real estate price indexes, and then use regression analysis and those economic factors to be able to forecast where those indexes and where the real estate prices were going to go in the future. So if I can build an economic model to forecast where these real estate price indexes are going to go, then I can forecast the price indexes and then use the property derivatives to trade off of that research and off of that information to profit by trading in the property derivatives based on fundamental economic forecasting methodologies. Then the last chapter, chapter 6, got into the application of using property derivatives by institutional investors to be able to hedge off risk. And what I thought was pretty amazing was that if these property derivative markets actually did flourish and develop, that actually if I was an institutional investor and I wanted to build a $2 billion portfolio of apartments or gain a $2 billion exposure to apartments within my portfolio, usually what I would have to do is give an advisor the $2 billion, and they would go out and invest the $2 billion in a single account, or I would give them the $2 billion to invest in their commingled fund, their closed-end fund, and then they would then take the $2 billion and go out and buy the property. Well, to be able to do that, that could take up to 2 to 5 years to be able to develop that exposure. But if the property derivatives market was deep and liquid, the $2 billion would have been given to the advisor, and the advisor would have bought basically long forward contracts or futures contracts or short calls on the futures contracts to be able to expose to the apartment market instantaneously in the derivatives market. So 2 years to gain a $2 billion exposure at the national level in apartments, or take the $2 billion and work with the investment banks to basically place the $2 billion in long derivative securities based off of the indexes. That placement of that trade theoretically would have taken 2 weeks as opposed to 2 years. And then once the hard asset manager found the property, we would liquidate the derivatives contracts and use that money to buy the properties. So we were actually using the derivatives to expose to our portfolio strategy and gain our exposure, and then use the liquid derivative contracts as cash management tools to then liquidate the contracts and use the cash to buy the properties as they came available. So that's basically the look in the, and if you want to take a look at it, you can take a look at it. And if anybody's interested in publishing any of the work in the dissertation with me, I'm looking for some people. I think I can probably publish 3 to 4 articles out of some of those chapters. And I'm now looking for students that want to co-author with me and to publish in one of the real estate academic journals, which I think is a pretty cool thing to be able to do, especially if you want to go on to Wharton or Harvard or MIT or Stanford or Cal or something like that, and to be able to say that you co-authored a peer-reviewed journal article and you actually published it. That would be, and then you could use that article to be able to show prospective employers that you worked with me on one of these research papers. I think they would kind of do that too.
When?
Yeah.
What's that?
Yeah. And it doesn't take that long. We would probably meet once a week, the first week, for like an hour to go over the strategy. Most of the papers are already written, so they need to be put into publication form, and then maybe some updating of the literature, and then just edits. And then we were able to turn around my FFO paper within 3 weeks, okay, to publication. I'll publish that this week. So the turnaround's really good. You're not writing the paper, and I'm not writing the paper. It's already written. So we're just updating it and then putting it into publication format, and then you get to co-author it. So I think it's a pretty good deal any questions on this? Okay. So let's kind of go through some of the questions. So what was the motivation for the research? Well, the company did not have a research function, did not have a strategic research function, and the strategic research function, along with the research-driven strategy, was a prerequisite for institutional investors. They're not going to give you billions of dollars if you're going to be opportunistic. You have to have a strategy. You got to communicate the strategy to them using corporate finance, and in this case, institutional real estate language and models. So I needed to be able to be dual. I was multilingual because I could talk real estate and I could talk corporate finance. Okay, and that's what the advisors, the consultants, and the institutional investors speak in that language. They all went to top business schools, so they understand that stuff. What was the business case for the research? Well, if we built a research department and we produced a strategic research report that guided the firm over the next 3 to 5 years, we would be able to attract billions of dollars from institutional investors because we met the prerequisite. Yes?
So Moodle, right?
Yeah, it's up there too. You want me to see if I can find it for you?
I can find it.
Okay, okay. How was the research to be commercialized and used by the sponsoring firm? Well, the research was going to be used on an annual basis and a quarterly basis. We did quarterly reports that basically updated the markets, confirming that we were in the right markets and we were tracking the markets, to be able to identify when we should enter and when we should exit those markets, or when we should increase exposures or decrease exposures to those markets. The other was also to build a research presentation to be able to communicate to the board and also institutional investors. And then also take those research reports and make them available to institutional clients. What was the research mission? So here were the main objectives. We were going to show why real estate compared to stocks and bonds. The other was why apartments compared to other real estate asset classes. And then why apartments in the Bay Area and other markets, and then why our company compared to the other REITs. So putting it in a capital market context. And then the other was, how do you actually construct the portfolio and the market selection models? First, you had to create a model, just like you do to select the stocks and the bonds. You have to create a selection model. Once you have the selection model and identified the markets in which you want to go into, then the question is, what's the allocation across the markets? And you're already doing this stuff. In this class, you've already built the passive portfolio. So we're applying the exact same methodology. Then the portfolio applications, geographic diversification, economic base analysis, coming up with the optimal weights using active passive strategies. Then once you build the portfolio, you've got to measure the performance against a benchmark. And then you got to have exit strategies and maybe other diversification strategies. And then lastly, you got to build the index, and then you got to design the derivatives to hedge off the portfolio's downside risk. Okay. The goals was to present a methodology associated with constructing a model institutional grade commercial real estate portfolio utilizing modern and postmodern real estate portfolio theory applications. This, everybody understands this that you're talking to, especially the consultants and the advisors. Okay? And educate real estate portfolio managers, institutional investors in the academy in capital market theory applied to institutional commercial real estate portfolio construction and management. The literature and the education is deep in fixed income and equities. It's pretty thin, in real estate, although there's been a lot of literature that's been developed in the last 20 years. And most of the literature was cited in the dissertation, by the principals who designed it. And you have to have external validity when you do this stuff, because they're going to ask you where you got the idea, how'd you get the approach, how'd you test it, did you look outside, did you do the research, who did you talk to, all that stuff's going to come up. So these were the research questions and the hypotheses that were basically proposed. You know, why real estate in a multi-asset? Why would you add real estate into a stock bond portfolio? You guys already know this stuff. How do apartment portfolios rank by return to risk adjusted? How do you select real estate markets and forecast the performance? What are the methods to construct an optimal real estate portfolio? What are the methods and metrics utilized to benchmark performance and make hold-sell decisions? What are the accepted methods of index development for property derivative trading, and why apply property derivatives to hedge or go long the markets? This kind of sets out the frame. So then there was Markowitz's book, right, and half a dozen other portfolio management books. You're using the Bodie, Kane, and Marcus book. That was also used and cited, in the literature as the basis of the external validity. Also, there's plenty of articles. This is just a sample. If you look at the back of the dissertation, there's probably 20 pages of citations for each of the individual chapters, again, to support the approach and validate the approach. Then the data. I pulled data from BLS. We had internal data. We had external data. I was getting provided data from investment banks. I was getting data from McGraw-Hill, which is owned by Standard & Poor's. I was getting data from all different data. So I had to have a database repository to be able to put the inventory of data in different locations and then create a relational database to be able to pull from those data sets, to then to be able to create the data cubes, to then to be able to mine the data from the models that were constructed to get the research results and then make the recommendations. So it was a pretty aggressive strategy. It took me about a year to develop everything and then present the results, so a year. So the assumption was that efficient real estate and security capital markets require strong public and private sector cooperation, disclosure of government and corporate financial conditions, and institutional and individual investor confidence in both the financial and political institutions. So your portfolio and your real estate assets are not going to perform if you have messed up monetary and fiscal policy. So you got to elevate yourself up to the institutional analysis first and then drill in to the microeconomics to get the results. So I built a theoretical frame that basically states that if you're going to value, you guys may want to look at this one because this is right up your alley. So my thesis was that if I want to value real estate, and you could use stocks and bonds as basically the dependent variable in this model. I basically stated that if you want to forecast the value changes in real estate, that you need to have a multi-factor APT model using accounting factors, okay, as one linear regression equation. Okay, so you have the accounting factors, and then you have to have the finance factors, and then the economic factors, and then the administrative institutional factors, then the political factors, the legal factors, and then other factors. And there's factors in some of these models that are also in the other models. So any movements of any factors in any one model is going to move the valuations. Now, the problem with this simultaneous equation approach is that this is a simultaneous multiple regression approach. Okay, when I designed this in 1996, we did not have big data applications, we did not have cloud computing, so it was an impossible solution because I didn't have the data. Now I have the data processing, I have the storage, and I have retrieval capabilities through big data applications. So I can actually build this model and solve these multiple regression equations simultaneously, in real time, continuously, and then to be able to monitor the valuation changes and then trade off of it. Or advise the clients on where the valuations of the equity in their portfolios are going to go over time. Now, obviously, you have the error terms that you have to deal with because there's always model misspecification. But what makes this model work, especially here in the United States, is you have homogeneity across the political institutional landscape. You have a standardized language, you have standardized logic and sociology, you now have technology standardization, you have telecommunications standardization, and you have a standardized cognition and logic. I mean, we are all basically the same individuals, even though we all think that we're different. We all live within a Western democratic capitalistic conformity. We're all educated, we learn basically the same models. So our rationality is bounded in rationality, but if you go and you try to apply this in a different country like Mexico or Southeast Asia or Eastern Europe, a lot of these institutions are broken down and the model really doesn't work, okay? But it works here in the United States. And we also know that historically, if you increase the number of assets within the portfolio and the assets within the portfolio, the returns have low, no, or negative correlation with each other, you're going to eliminate the unsystematic risk and you're only going to be subjected to the systematic risk, which is reflected in the data. But the problem for you guys is that over the last 15 years, particularly since 1995, the volatility and the systematic risk has increased significantly over the years. So now you are managing in a highly systematic, risky environment with more systemic and systematic risk than ever before. So the question becomes, how do you manage as a risk manager and an investment manager in an environment with very high systematic risk? Does anybody know the solution? There's a solution to everything if you're creative. You could hedge. Anybody else have any ideas on how I could reduce the systematic risk? Anybody have any ideas? My recommendation is the way that you lower systematic risk is you take on more unsystematic risk and you push down the systematic risk. So instead of taking sector tilt exposures at the macro level, what you do is you focus on the microeconomic level and drill in to the specific property in the specific location based on the demographics and the economics and other economic factors at the microeconomic market level, as opposed to exposing in strategy at the macro level. Then you can push this thing down, and you're taking on. That's really hard to do. That's really hard to do. And over the years, there's just been more volatility, and we've seen market. Am I out of time?
Yeah.
Okay, sorry. I'll pick this up. But read through these questions, and I did provide you with a presentation of the questions. So you can follow them. Yeah. What?
Could you show me where that slide is?
What this is?
Yeah, where it is.
Oh, I show you where the presentation is?
Yeah.
Yeah, I'll do that.